All right, good afternoon, everybody. This is Gavin McGuire, event trader. I should be joined here any second by Brett Manning.
Hey, how you doing, Gav?
What's up, Brett? Who is, of course, chart trader. And Jim's also going to be jumping on here in a little bit, too. Just popping off some questions and helping Brett and I keep organized and focused, as per usual. How's your morning going for you, Brett?
Catch my breath.
Oh, pretty good, Gav. How about you?
No complaints at all. Just took that long in CLF, which is working out so far. So that's always a good start. I saw you were looking to short the NQs. I tried a similar thing on Friday with limited success myself. So you want
this was a scalp trade. This was a scalp trade, and it was actually I got what I wanted as a minimum viable trade, which is why I took half of it off for 12 points. I was actually thinking, I know for a fact that I'm going to get these 12 points, and I don't know if I'm going to get more. And I like to take trades like that because, you know, my expected result is pretty much what happened, except for maybe how much of a rally we saw. If I had expected that, I probably would have turned around and gotten long rather than closed it out, just reversed the position. But I did feel extremely confident that we would break below that 73.15 level. So when we got a bounce up into the 73.25 area, it was just an easy, quick little scalp.
Yeah, I kind of ran into the same thing when I was looking, when we were up at that 73.90. I was looking for a breakdown to 73.50 on Friday, and I think I just ended up getting in too early, obviously, on that one. I should have waited for that double top around the 74.10, but hindsight's 2020, as they say, right?
Indeed.
So obviously we got a really big week of earnings going on. Easily probably the busiest on a qualitative and quantitative standpoint, with 180 S&P companies coming out. However, one of the more interesting aspects of this market that we're going to touch upon right now in this segment has certainly been the 10-year yield, which we've seen the spread bounce about 9 basis points over the last 2-3 sessions here. So wanted to sit down and address that with you. And we also have, of course, a busy week, week and a half of central bank meetings with the big three coming out, with the ECB on Thursday. The Bank of Japan is the 31st, which is next Tuesday night. And then the Fed, of course, has a 2-day meeting starting on Tuesday, July 31st, and concluding on August 1st with the latest segment. So bond yields will certainly be playing a pretty important backdrop to what we're seeing going on in earnings. Right now, I'd say earnings is not really proven a significant contributor to the bull or bear argument at this point. So perhaps it's the bond markets that could provide the most volatility. Now, Brett, with the 2-10-year spread, obviously there's a few things that have been going on since the middle of last week, and you want to touch upon what you're seeing right now?
Yeah, sure. First off, something that I think is a very widespread misunderstanding. I can't believe how many people, I think, really feel this way, and I just kind of want to disabuse people of a particular notion that is often reported in even big financial media sources like the Wall Street Journal and Financial Times. There's an idea, and it's just plain wrong, that the expectations of an increase in policy rates by the Fed will be manifested by an increase in long-term interest rates. That can happen, but only if the entire curve is moving up. If you see the rate on the U.S. 10-year move significantly higher, and you see the rate on the 2-year or shorter not move very much at all, that is generally anything but a sign of expectations of policy hiking by the Fed. In fact, it's probably an expectation of the opposite, that the Fed would see growth and not hike as much. That would explain a widening or steepening yield curve. A steepener trade is, generally speaking, based on the idea of, on some degree, taken as an extreme, you'd say that it's the Fed falling behind the curve. The long end responds to growth and inflation and a lack of demand for longer-term debt. And one reason why people would not want to buy longer-term debt is because they believe their real returns on that debt won't be high because of inflation. So, generally speaking, rates at the long end of the curve go up in expectations of inflation. And one source of inflation would be the Federal Reserve not tightening policy fast enough as growth takes off. That would be the main source of inflation in terms of the basic monetarist view of policy. So, when you see something like we saw on Friday, where you see the long end of the curve take off and the short end of the curve stay anchored, it doesn't stand to reason to suggest that means people are expecting more hiking from the Fed. So I think that's a really common misconception that people have. They just think of interest rates as this one big factor. Oh, interest rates are going higher. That's because the Fed is going to hike. And interest rates at the long end of the curve are not controlled by the Fed. Interest rates at the short end of the curve are controlled by the Fed. And interest rates at the long end of the curve represent people's beliefs about how what the Fed does will impact things in the economy, like inflation. So one way to explain a flattening yield curve, like you see on the chart right in front of you right now on Trader Audio's screen, you see a flattening yield curve that we've seen go on now for several years, getting flatter and flatter and flatter. In other words, the spread between the 2-year and the 10-year are getting narrower and narrower and narrower. And that would suggest that as the Fed keeps hiking, that there is less and less of a belief that we're going to see a sustained inflationary threat over time. So you're seeing it flatten. And one way to look at that is one might want to say that that suggests something like the Fed is maybe being too aggressive with its hiking. But there's a lot of different factors that can figure into that spread. But I just kind of wanted to make that point first. That there are very different forces at work at the short end versus at the long end. As far as theories about, so going back to your original question after that little tangent, as far as theories about what happened late last week, you can cover them as well, but I mean, basically we're seeing a lot of different, we're seeing people react to the sense that for some reason in the last couple of days, the yield curve has been on a sharp steepener trade relative to how it had been acting in the previous few weeks. And one way to account for that is just basically that people are seeing signs that maybe, there's more wage inflation being baked into things, and it just happened to coincide with Friday, not because there was some specific catalyst. There's also some sense that the Bank of Japan, as I'm sure we'll talk about in a bit, has been trying to do something extremely unique in the history of monetary policy by artificially depressing the long end of their curve. So contrary to everything I just said, the Bank of Japan is actually controlling the long end of their curve, which is really strange. They've got this very special policy situation going on where they're holding their 10-year rate at 0%, and there are some rumors that they might start to let that go a little bit, and then you're faced with this idea of how far away is the real rate for Japan. And if it's gotten a long ways away, then as soon as they start to lessen their control, there could be a sharp reaction higher, and since there's a lot of cross-border flows in terms of bond markets, that pushes up long-term interest rates around the world. So it could be some discounting of that idea, or at least some hedging against it. And then I suppose there's also some theories about the fact that this move coincided with the latest threat from the White House in terms of tariffs on China. China is the biggest foreign holder of our debt. I suppose people could be scared that one way China might retaliate is by selling U.S. long-term debt. So, and then finally, something I think you can't completely dismiss would be what I would call essentially a hedge against the possibility that Jerome Powell has character problems. And that would be one way to phrase a situation where Trump saying, I don't want you raising rates anymore, would actually impact Fed policy. I think it's unlikely that that's actually the shape of the universe, that that's reality. but it does coincide pretty well with Trump's speech telling the Fed to not raise interest rates anymore, and then suddenly we're seeing the steepener trade a couple hours later. If you were to believe that Jerome Powell would be influenced by that coming from the White House, then this is one way that might be manifested. I don't believe that that's the case, but the market is doing that. So,
if you ask, you have a favorable.
All right, yeah. So I mean, basically, what you're seeing is this kind of feeding off upon itself, whereas the slowdown in the 2-year acceleration is leading to the idea that there's going to be more inflation, i.e., the Fed falls a little bit further behind the curve, and thus it's kind of feeding off itself with the steepening part of it. And at the same time, too, you felt that the flattening was kind of a feeding off of where the Fed was raising too quickly. Would you say that?
Well, I mean, it's
that's why it was just going to choke off growth.
Well, I mean, eventually that's what happens every cycle on some level. And the question is, where are we in the cycle? And if you look at, I don't know if Jim can readily scroll that chart so you can see the very, very long-term picture. But if you were to look at what that chart looks like over the last several decades, there's a cyclicality to the yield curve, and as you get later and later in the cycle, it gets flatter and flatter, and eventually it inverts. And one way to look at that is that, eventually longer-term estimates of the next 5 to 10 years for the economy start to suffer while the Fed keeps raising rates. And that's, the fundamental force that, all the way back, like keep going, there you go. So you can see how these cycles play out. Early on in the cycle, you see it steepen widely, and then as the cycle progresses, as it ages, it gradually narrows. And that's what we're seeing now, and eventually you see those gray stripes, and one of those gray stripes will happen, and that's a recession. Yeah. But one thing to remember is where we are right now is the same place we were in 1995. It's the same place we were in late 2005. It's the same place we were in 1987. And in all of those situations, for the most part, except for the blip in 1987, that wasn't really a cycle end. There's always a year or two lag when you start to get this tight, and sometimes many more. If you look at the late 1990s, we went 5 years of the single best stock market gains that we've seen in a century during the period that followed where we are now in the cycle for the yield curve. So while it may suggest that the cycle is aging, there can be some of the best gains for people in the stock market looking ahead the next year or two from this point. But eventually, this is going to be on some level the beginning of the end of this cycle.
All right, so let's take a look at some of the factors that we're talking about and see, do like a little bit of game theory with them. So the first one you touched upon was the Bank of Japan. And their early talk is that they could be looking to tweak their policy in their upcoming meeting on the 31st. Now, Bank of Japan's obviously been a very active buyer in the markets, and the thought is that they are currently now the anchor for interest rates, and if they are going to move off, that they could potentially be driving some of the interest rates around the globe higher and on the longer end of the curve, and we're kind of seeing that potentially playing out in the 30-year. What kind of weighting would you put on the Bank of Japan and the potential for them to move? What do you think would be some of like the bigger fallouts from that?
No, I gotcha. I think it's a bigger factor than it seems on its face, because it sounds like such a dry thing to discuss, but if you go back, God, I guess it was, when did this started in September 2016, did it not? Where the Bank of Japan started doing this, we're going to target the 10-year, and we're going to pin it.
Yeah, it was right around the turn of the calendar.
Yeah, it wasn't, but September 2016, I think, right? We're coming up on 2 years. Yeah, this policy. Yeah, and I remember at that time it was a big story, and I really focused a lot on it because it seemed like such an extraordinarily dangerous thing to be doing.
It was a very targeted operation twist, right?
Yeah, super like, but where they were saying what we're going to do is we're going to focus policy on pinning the 10-year to zero, right? That was the idea. We're going to pin the 10-year to zero. No matter what happens, 10-year is going to be zero here. And the danger there is that you can kind of think of, well, there's there's the Japanese 10-year around zero. It's going to be around zero, but that's a finger on the scale situation, and there's a real theoretical rate. Like if they weren't doing anything, there's a different 10-year rate that you can imagine existing in theory that diverges from where the operative day-to-day 10-year rate is as they hold it at zero. And it depends on how far away that theoretical other sort of natural interest rate gets from zero before it starts to become something that is truly insane that they're doing. Like at a certain point, if you imagine it was supposed to be at 5%, that would just break the system. They would not be able to do that, and somehow the force of monetary operations they'd have to be doing would be so vast that differential would show up in some other way. Whether it's some kind of swaps or something crazy would be going on. It would, on some level break the Japanese financial system. And they know that. So they would never continue to do this when you get this situation where it's too far of a stretch between those two interest rate possibilities, right? The day-to-day real one and the sort of more natural one if they weren't doing anything where it would be. So as it starts to diverge, they have to start to lessen that control because they don't want to have to give up that control all at once and see it, zip to the other level. If that's a long ways to go, then they're going to end up hurting themselves in the process. So as it starts to diverge, they're kind of forced to make adjustments. And this might simply be them starting to say, we need to start letting it float up a little bit because the difference between those two ideas is starting to get to the point where, we're forced to make a change, or else we risk putting ourselves in a situation where there could be a seriously negative consequence to this, what is a really, interesting and unique version of monetary policy that they've been doing. It's very, I guess, experimental, and I don't think that they would want to risk letting those two ideas of rates diverge too far before they start to allow it to adjust. And I think that maybe some of the action that we're seeing right now is this is the first time where we're going to see that experiment start to, they're going to start to loosen their grip on that beach ball that they've been holding underwater. And maybe there's a little bit of concern that as they start to do that, there could be some violent reactions in the markets. And probably one way to look at this move, if you want to see this as being the primary factor, then a lot of it could be hedging. You could be shorting long-term bond futures all over the world in response to protecting your portfolio against the possibility of a sharp shift in long-term Japanese interest rates as they start to kind of loosen their grip on that beach ball.
Right. I would say one of the things that people could argue against this point, now I think that this has a lot of weighting on what's going on right now in the longer term, but the Bank of Japan's balance sheet's actually been slipping since the turn of the year, which suggests that they've been trying to get out and, stealthily start their unwind without really mentioning it in their directive or in their statements at all. So, but I mean, that's going to be a big buyer moving out from the markets, which will certainly have an impact really across the boards. Now, I know you've played a lot in the Nikkei futures. Do you see any sort of trade in the Nikkei futures on this end? I mean, if you got a big buyer moving out, my thinking process is that this could potentially set up for a short there.
So,
Iranian Revolution.
I am still basically of the opinion, if I take a big picture view of things, I think that probably the policy differential is the important thing. Now, maybe there's a short-term trade because there's the possibility of volatility there, and people might bring money back home, and it pops the yen back up, and it hurts the Nikkei, and there's all those little dominoes. But I think I have enough of a bias to say that I think the yen is weakening. I think that the dollar is still in a bullish trend, and I think that the Nikkei is one of the principal things that can benefit from that. And if we see any of the world's major markets follow the NASDAQ to new all-time highs, over the next few months, I would think that one candidate is the Nikkei. So it's hard for me to want to short it.
Right. Okay. So one of the other theories we're going to discuss, of course, is the president's comments on the Fed. Now, personally, I'm of the mindset that if anything, the Fed would, I don't think it's going to have much of an impact. Now, I know obviously President Trump put in Mr. Powell there. He's also named four governors that are going in. There's a fifth one that still has yet to be named, so there's another potential candidate out there. But I just don't see the president as having a ton of influence on this. I kind of view the central bank as the fourth branch. So I'm more of the mindset that this could potentially cause them to press forward with the 2 rate hikes rather than really kowtow to what the president's saying. Now, I know you weren't saying that at all, but in a game theory situation, how do you see this playing out in this September and December?
I totally agree with you. I mean, I've seen I think a lot of people have voiced that same opinion, and I completely agree with it. I would think if I was the Fed, you don't want there to be any possible perception that the White House has had any influence on anything, because that erodes confidence in your ability to manage that situation. So
similar to what we saw with Burns in the 70s with Nixon, he kind of kowtowed, and there was that pressure there.
Yeah, you cannot make it appear as though there's a number of different ways though to achieve the perceived independence of the Fed. So the question is, are there other ways that they could satisfy that without it influencing their rate decisions? But yeah, I completely agree. If they're right on the fence, and I mean, especially if there's a timing to things too. Let's say they get to the next, we get to September meeting and the Fed's expected to hike. But there's been some data suggesting maybe a little more weakness than they perceived, and they're kind of thinking, hey, maybe we shouldn't hike now, maybe we should play a little wait and see. And then if that morning Trump tweets out, the Fed better not hike today, then they're going to hike. There's no question that would tip them the other direction. I think if there's nothing else from the White House about it, it probably won't have any impact at all. But of course, we only see, what's out in the press, and we don't know what conversations go on behind closed doors and anything else, and nobody else does either. So, one has to respect the fact that there was coincidental timing to, a major national interview coming out, and the president not just saying, I don't think they should hike, but then following up with tweets later and really reinforcing the idea. And then I thought a really odd something popped on the wires later that day that I found so strange, which was the White House spokesperson reaching out to CNBC in the afternoon, reaching out to say that Trump doesn't believe they should hike anymore. However, aides at the White House are telling him that the Fed is doing the right thing. They reached out to send that message to CNBC, and then that went out on the newswires. And that was such a strange strategic move, because obviously, Trump okayed that entire message. So it's not like that was a real portrayal of things going on at the White House. That was a very strategically placed message, and I feel like it's sort of a, trying to have your cake and eat it too kind of message.
I'd look at it from this perspective here is, say we do raise 2 more in 2019, and then, we've seen a lot of recession calls for the next 12 to 18 months. I mean, at some point we will get a pullback, we will get a recession. That's pretty much inevitable. And I get the feeling that this is being dressed up as the ability to scapegoat and find another reason. And that's kind of where I took it from, in terms of his, hey, just want to throw on people's radar that, the Fed could be slowing us down here. We're doing everything we can on the tax side and stuff like that.
I think you're so right. And that would explain that message that I just said, because he can then cite that next year if we go into recession, saying, my aides were wrong, and I was right.
Exactly. And I mean, and it's something we've seen from the administration from the get-go, going back to Davos. Davos when Mnuchin kind of made the veiled comments. I wouldn't say he was looking for a weak dollar, but he certainly didn't support the Rubin strong dollar theory when he was questioned about it. He just said that the dollar trades where the dollar trades, and at that time the dollar was pretty weak, which some people took it as, kind of a wink towards them being okay with a weaker dollar. And given the fact that they are in a pretty heated trade battle with China, it's not surprising that they would kind of look to weaken the greenback a little bit, especially when you look at the move in the yuan over the last couple of months, where that's seen some significant weakness. And I'm sure some of that commentary was to try to kind of unseat that ability for China to take advantage of that FX currency translation.
Yeah, but that's just another piece of comedy, isn't it? I mean, you make moves to do unquestionably to scare money out of China, right? To weaken the Chinese economy. Like this is the point of the tariffs, to put them up against the wall until they give in, and that helps your negotiation and it helps the trade terms you get. That there's no other point to the tariff moves. That's the point of the tariff moves. And you can't then blame them for weakening their currency strategically. Sure, they're letting it go, but they're not pushing it down. There's huge capital flight going on in China again because there's a gigantic debt bubble there, and now they're getting put up against the wall economically. I mean, they would have to be working very hard to support their currency, intervening on some level in a serious way. And
just on that note, there's a bunch of discussions about liquidity being pumped into the Chinese market by the bank today. So,
I mean, they're trying to support it. They're not overly trying to support it because, yes, the weakening currency helps their situation right now. It's exactly how floating currency markets are supposed to work. So you can't blame them for not having a floating currency market. To say that they are weakening it artificially to try to hurt the United States, they're just letting it go because that's one of the consequences of threats of $500 billion in tariffs. When you have a situation that is, potentially precarious economically, especially if you get capital flight, especially if you get everybody who's got a lot of money in China trying to get their money out before it's more seriously devalued as a bunch of debt is written off. So I think it's just kind of, obviously none of these things are necessarily meant to be
I guess that's why they've been voted one of the world's
extremely factual statements. It's all, there's just a lot of political strategy, but it seems odd to me that they would think that accusing China as a currency manipulator is a viable strategy to play things in the media right now, given that the currency is weakening because of the tariffs.
Right, and then, I'd agree with that. But then, we'll go on to the third theory that you had discussed, which keeps on the China line, and that is China selling their treasuries. They hold about 1.15 trillion of treasuries, which makes up about a third of their balance sheet. Now, I mean, this is kind of a cut your nose off to spite your face type move if they were to do it, given their large holdings. So I just don't see that as being a viable option for them. That's kind of a nuclear option, and I just don't feel like we are anywhere near that. They have a couple other ways that they could battle a trade, and I just don't see themselves looking to really crush their own balance sheet here by selling those treasuries. Now, but the game theory, let's say they were to sell those treasuries, I'm not sure what their holdings are. Do you know offhand if they've been concentrated in the short end of the curve or in the long end of the curve? I mean,
I think they have been shortening. I think they have been shortening, but it was concentrated, I believe, massively to the long end of the curve, and this really ramped up 15, 20 years ago, and when they started to build huge reserves after the late 1990s, and they started to pour it all right back into U.S. treasuries, and I think it was very concentrated toward the long end of the curve, and over the last 10 years or so, it's gradually started to tip into shorter and shorter holdings, which is one thing we've seen a lot of folks do.
And again, for the users out there that are just listening along, when Brett's talking about shortening, basically, that's moving from longer duration to the shorter duration, and thus you'll see the average duration, it could be running, say, 7 years, which means all total, that's the length of their holdings. And if they're shortening it, that would move towards closer to, say, 5 years. So that's what's going on there. It's basically just a change in theory. And if you're talking about that over the last 10 years, that would be something that could be certainly reflected in the form that we've seen the 10-year spread take.
Sure, but there's one other point here to bring up about, I totally agree with you. I don't believe that they're actually going to mobilize this strategy, but that doesn't mean that the market is not hedging against the possibility, which means there may be lots of folks who believe that if the United States does something too aggressive against China, that at least China will start to vocally threaten to try to trash our, long-term interest rates, which in theory they could. But again, I agree with you.
You'd see a huge spike in yields in this scenario, and you'd see a drop.
Yeah, if they were to put the threat out, it would hurt bond prices. And so
your 30-year bond would look like the short you have in the 30-year would look like a great trade for sure.
Yeah, so maybe people are just positioning ahead of the possibility that the pressure from the United States will cause that threat to come out. It's one possibility, and that was, Friday is again where we saw this move start that we've seen over the last couple of days, and Friday is when Trump put the $500 billion tariff threat out. So it's possible that it's sort of like we're seeing a big mix of factors that are sort of all partially contributing, like you said, with the weighting, and there may be just hedging or speculation about China using that threat of the nuclear option, not that they would ever actually do it.
Right.
But even the threat hurts them, just like you're saying. I mean, like even doing that hurts them on some level.
The president is telling
it's like they would both be grabbing each other and jumping off the cliff at that point. So I mean, and really everybody would have to go look for some cover there, and that could certainly cause a global recession if we saw them go down that path. So I just don't see that as being a viable path for them unless they reach that breaking point, and I just don't simply see them there. But all right, let's take a quick gander then at the ECB coming up on Thursday, Brett. What do you see coming out of that? Obviously, we're going to be looking for a little bit more color from Draghi on that mid-2019 target date that he had provided for when the ECB might start to raise rates. Obviously, an update on any color or commentary on the economy going back there. We will get before that some PMI numbers from Europe, and that's going to be out early tomorrow morning, so that'll help kind of set the tone for how the economy is going. But what are you going to be looking for in that ECB meeting?
I think I'm going to say this, and I could end up looking like an idiot, but I think that at least a small percentage chance that we already hear Draghi hedge a little bit about the possibility of ending QE by the end of the year, which is...
Well, that's already been done, right? I mean, they've already talked about looking to drop it down to $15 billion in purchases after the September and then ending it in 2019.
No, I understand. So, but more of an official statement during a press conference of an ECB meeting, I think, would be, even lengthening it out more, or just saying, just basically
unanimous, like throwing in something decisive like that.
Well, just walking back the idea that they are in any way normalizing right now, because I don't see the advantage, and I think it's possible that
it's an asterisk.
I think it's possible that it could happen. I mean, just the direction that everything is going. And you've got to remember, they've got the hard Brexit threat, and they have the same trade war problems that China and the U.S. do. All three economies are all three concerned about, the same impact. And the United States is the only one that, in the middle of this, has what is, in effect, a gigantic fiscal stimulus hard at work. And the other two don't. And Europe doesn't have the capacity to do that, given that the ECB is not a monetary system for a single governed country. They can't, their policy can't be buffered by fiscal policy, not yet. So we talked about that as a huge development. If it could happen, that would be the most important thing for Europe if they could find a way to do that. But at this point, they don't have that channel, and the United States actively has a fiscal stimulus. So if you look at the divergence trade, going back to the idea of this policy divergence trade over the next 6 to 12 months.
Sure.
I think that's the factor. As things ramp up with the trade war, the United States has a fiscal stimulus in place, and so we might see places like Europe, if they start to try to normalize, walk that back, because there's too many risks out there. So,
because they don't have fiscal stimulus supporting them like
they
the U.S.
can't.
does.
Right, yeah.
What do you think of the euro right here? Obviously in a tight consolidation in that 116 to 118 level going back to late May. Do you see anything that would be decisive enough to break it out of this tight channel?
Well, I think that would. So, I mean, or speculation about that, or a sense of that. And I still just kind of hold a generalized view of the dollar as strong right now, and probably the euro is headed for lower lows.
It did take it down, but
We continue to see at least a slight margin net spec long when you're looking at CFTC data for euro futures. It's not, it's not a big net long position like we saw a couple months ago. But if you look at where the euro was in terms of commitment of traders data back in 2016, it was hugely net short. It's not like it's one of those markets that never really goes net short, and it just oscillates between big spec net long and small spec net long, like you see with essentially crude oil and gold and a number of commodities. The euro can get, big net short. So a transition to, move down below this whole 115, 114 complex to test 110, 112, 113. As we start to see this policy divergence trade play out, maybe that gets us to a big net short in the euro, and that's when you start to look to buy it. But I don't see any reason why that sort of process wouldn't happen, given, again, this, the fiscal stimulus at work in the United States, the higher interest rates in the United States, and the possibility for a number of different risk factors to hit Europe. It just seems like it's an odd situation to have a net spec long position, and it still is a downtrend with a lateral consolidation. So I'm probably still leaning to the short side. Sure. I'm willing to give up that idea if it shows me, if we get exactly what I just talked about from Draghi, and the euro dives down and rallies all the way back, then I'll be done with looking to short it.
All right, and then Bank of Japan, we've gone into pretty good discussion about, but what kind? Let's say the reports are true, and we do see them kind of start tweaking a little bit. What kind of fallout would you be looking at? Is there any asset class that you'd keep a closer eye on?
So again, I think this is a situation where it depends on what they say, how that impacts the 10-year rate in Japan, how big the difference is. And it's sort of like nobody knows where that theoretical natural 10-year interest rate for Japan would be, and how far underwater that beach ball is being held. And I guess it's really about trying to see if they start to loosen their grip on it a bit, how sharp and how fast does that move happen. And I think that if it were to show signals of moving really quick, that would probably unsettle things, but it would be, I'm already short the U.S. 30-year, and I would probably benefit from that situation. I don't think that it would be that big a deal in terms of a sticky problem, so probably buy the dip in other things if we started to see, just a little bit of markets being rattled by that response. But it is a really strange experiment involving a really massive amount of money in a globally integrated financial landscape. So it's possible that there are ripples here that you just kind of have to probably play read and react. We've never really seen this kind of situation in its specifics play out. I guess that there would be flight to safety possibilities in terms of probably not bonds. But, the same thing we saw in early January, we saw when that whole,
the world's most popular
when a lot of the hedges broke down for things, when you saw equities and bonds moving lower as that sort of risk parity strategy wasn't working out too well. It was tough to find hedges then, but the yen was certainly one of them, which would play into your idea as, this being a short-term Nikkei short. Probably not one that I would take, but, it makes sense, because where are you going to find your hedges. Maybe it's also a time for gold to make a little bit of a bottom. I don't know.
Yeah, I was looking at gold actually. It's looking a little like it wants to. Obviously, way too early in that chart to make that call. But I just thought it was interesting with the Iran headlines, obviously on gold. But we'll save that discussion for another day. And finally, Fed. I mean, it's not looking to set up as an important meeting by any stretch. Not expected to move until September. They could certainly lay the groundwork for a September move, but I'd be surprised to see them move too far off the language. But is there anything that they could potentially do that would stick out to you as a little bit of an eyebrow raiser?
I suppose any commentary on the White House would be an eyebrow raiser. No, I don't think it's going to happen.
They don't want to go down.
Or maybe coded commentary. You know, maybe just including in there some press conference answer. You know, somebody's going to ask them, right? Or is there?
There's no presser.
Yeah, there's no press conference, right?
That's why this is irrelevant. There's no updates, projections, or anything. This is going to be. It's August 1. Everybody's going on vacation. Let's keep this as benign as possible.
I guess I got so excited about the idea of a Fed press conference at this point that my mind even jumped ahead to September.
Well, I mean, Bullard commented on it, so I mean, it's not like they're not commenting on it. So we'll continue to watch for that, but I just don't see them putting something in the communique like, you know, we don't listen to anybody else.
Yeah, so I guess the first possibility that I mentioned is there's some suggestion that maybe there's a little bit more baked-in wage inflation that's going to start to manifest itself, and that would be in line with my expectations, and it's why I believe in this policy divergence trade. I think that the fiscal stimulus in the United States and the fact that we have relatively less vulnerability to immediate effects from the trade war theme, in combination with what's going on everywhere else, suggests that, I believe that we're going to start to see more manifest effects. I think that there's a lot of stuff baked in for the U.S. economy. We could actually start to see, you're seeing, I think, a lot of signals that there's maybe more strength baked into the cake, and that we could be in a situation where maybe the Fed is seeing it, maybe the Fed starts to comment on it, in the communication that they change the language slightly around inflation. And then I think that maybe they end up in a situation where, later in the year, we start to get a sense that there's a need for, right now, over the next few meetings, definitely hiking HBU. And, I don't know if that's entirely priced in by the market when you talk about the first two of next year.
Yeah, well, I mean, we're also going to get a number of data points ahead of that, a lot of sentiment data this week, so that's going to certainly play a key role going on. Just to highlight a few for the subs, I threw it into my week ahead, but we got the manufacturing PMI starting tonight in Japan and then moving into Europe tomorrow, in the U.S., of course. We got a Bank of Japan core CPI number, which should be of interest. The prior number on a year-over-year basis was 0.5%, still well below the 2% level, and it would certainly suggest that the Bank of Japan's not ready to move. Ahead of the ECB, we're going to get the German IFO business survey, as well as the GfK consumer survey, so we'll certainly get a lot of consumer sentiment. And then, of course, on Friday, a big one ahead of the Fed meeting will be that Q2 GDP number, where current expectations are for that to run around up 4% year over year. So certainly some meaningful data points to keep an eye out on. I don't see any of them changing the narrative going around, but the bond market's certainly going to be one of the more interesting stories over the next 2 weeks, and might get a little overshadowed due to all the earnings that are coming out. So, Brett, is there anything else you would like to add on to this discussion, or should we cut it loose and then be prepared to jump on and discuss any actions that we're seeing as they come about in the next couple of weeks?
Yeah, that sounds good. I think we've covered the initial landscape here.
All right, well, hopefully that sets you guys up. Brett did a fantastic job with running everybody through where we stand on everything, and some of the expectations, and we'll certainly be discussing a lot on the page